we've been saying for some time, we think it's a V-shaped recovery. And we will, when we get to economic indicators, go through some of the indicators that are starting to bear this V shape out. Just one other comment I'd like to make. The dollar is something we're watching very carefully. It has settled down. It hit new lows, at least in recent terms. If you, in historical perspective, it's hardly moved out of its recent trading range, but it was starting to break down from levels over the past year or so. We are on dollar watch. The dollar is a good gauge on confidence in the U.S. economy, and it is also a gauge of whether or not our monetary policy is more inflationary than the monetary policies abroad. So happy to see some stabilization. Gold prices went out to a new high. Again, that's a question mark about is this an indication that inflation is about to take off? Or is it simply a commentary on how low yields are and how low the opportunity cost of investing in gold is? The other inflation hedge we pay a lot of attention to, as you probably know, is Bitcoin. And Bitcoin has had a bit of a breakout in the last few weeks. It looks like it's in the 10 to 13,000 range. I think we got up to 12,000. And that 13,000 is important because if we were to ever get through that, then in technical terms, there would be very little resistance. And we would probably be on our way back to the peaks we saw in late 2017. So around $20,000. Now, we're not sure if that's going to happen. We could stay in a new trading range, just at a little bit of a higher level than the recent 6 to 10. Maybe we're in the $10,000 to $13,000 range. Nonetheless, a breakout. And is this another inflation hedge starting to speak volumes about the risks out there? We do think that that investors in both gold and digital gold, Bitcoin, are taking out an insurance policy. And it makes sense because we are somewhat in uncharted waters. After 0809, we were saying we're in uncharted waters when the US central bank reserves went up to, or the monetary base went up to $4.5 trillion from $850 billion. Now, that did not lead to inflation, as we all know, 10 years later. Now we're going up to $9 trillion. Will that cause inflation, or are we in a spiral like Japan has seen in the last 20 to 30 years? Very hard to say. As I've mentioned before, we don't think we have an inflation problem in the near term, but the more complacent investors become about this, the more I will start to worry. Right now, we have too much productivity growth coming from a V-shaped recovery, coming from technologically enabled innovation to see inflation taking off. We also have oil prices still down 30% from where they were roughly this time last year. So that's another deflationary undercurrent tugging at the inflation indicators. There was a very interesting announcement this week by a company called MicroStrategy. I think it's MSTR. And it announced that it was going to use half of its roughly $500 million in cash and put it into alternative investments, including Bitcoin. And so I looked through to see who was making this decision. And what I found was, at least from the CFO's vantage point, he has seen the ravages of hyperinflation and destructive monetary policies. He was at Nextel Wireless in Brazil, I think during the European sovereign debt crisis when emerging market currencies were selling off. And he probably understands the risks associated with monetary policies gone rogue. He may think that monetary policies around the world have gone rogue, and that it's an important moment in time to at least put in place some insurance policies to guard against a destruction in purchasing power. So just thought that was interesting, wanted to share it with you. As far as the economic indicators, well, the biggest report of the week was the unemployment report today. And the unemployment rate continued to fall. It was a better than expected report, the unemployment rate going from 11.1% to 10.2%. And we saw average hourly earnings turn up after some very serious declines. So that was good to see. Last month was minus 1.3%. That's month to month. This month, meaning July, was up 0.2%. So that was very good. And hours worked are telling us something very important about third quarter GDP. If hours worked just stayed where they ended July, what we would find is that average hours worked would increase from the second quarter to the third quarter at a 22% annualized rate. Now, I think hours worked are going to continue to rise, and we believe that output per man hour, which is productivity, is also rising, perhaps very strongly. So it is possible that the third quarter's GDP could be 30%, could even be 35% at an annualized rate. And I think most economists are expecting something within the 10 to 25% range. I have seen one out there, I think, in the 30 to 40% range. So this certainly would be at the high end of expectations, and again would speak volumes about a V-shaped recovery. We also this week got a very interesting number out of the Purchasing Managers Index, the PMI. And it was higher than expected. It is above 50. That means the industrial world is expanding again. But if you looked through the guts of the report, you would have found that orders in the PMI were up to well above 60. And you had to go back to 2018 to see higher numbers. Now, what this tells us is that inventories have been declining, have probably hit too low a level, and perhaps much too low a level, and that businesses are beginning to scramble in order to catch up with demand. So that was very interesting. We also saw manufacturing hours worked in July up 1.8%, very strong, and overtime jumped dramatically from 2.5 hours to 2.8 hours. Again, this is another sign. I rarely see 0.3 hours jump in this metric. It is another indicator that there's a scramble underway, and that businesses are trying to keep up with demand. So